Welcome back to another edition of Primary Source China Investment. Peng.guo and I are switching it up a little bit. Today, we're going to cover two topics, policy and markets. And without further delay, let's get into policy. And this week, we're talking about China's neighbors and trade. And trade can't be decoupled from regional, social, and ethical issues. You're going to hear a lot about the Quad in the coming months. What was a loose affiliation of Japan, India, Australia, and the United States, a group of countries that want to maintain that China doesn't write or rewrite the rules in the South China Seas. The concern for this vast swath of sea and islands is really trade and how that plays out over time. It's natural for countries to try to exploit their comparative advantages, and China is no different. As we've covered in previous videos, they have the suppliers, manufacturing, and distribution on the export side, and the huge consumer market on the import side. No other country can match this. As a result, they've tried to link trade with other policies. We'll look at a few examples. First up is Australia. There's no better leading indicator to China's trade warrior attitude than Australia. First, a bit of context. China buys 32% of everything Australia exports and 100% of some key exports. But China's trade diplomacy hasn't worked. In 2016, Australia highlighted the growing concern of the South China Seas and the need to increase military presence there. 2017, there was this mole in the parliament scandal, which led to new laws designed to keep Beijing out of Australian politics. And by 2018, the Australian government banned Chinese tech firm Huawei from its 5G networks, the first nation to do so. But the final act of rebellion from Chinese Communist Party's perspective was Australia's response to the COVID-19 pandemic. So China pushes the button it has, the access button. China banned the import of coal at 5 key ports and created paperwork at others. And things were off to the races from there. Soon came bans on everything from barley to beef to wine, then cotton, copper, lobsters, timbers, and hay. Now, this is a harbinger for more trouble to come. And when you call China out, they're going to ratchet up the trade rhetoric. So this, along with the other aspects and other countries we're going to get to, is the preface and the premise for what we're discussing today in policy.
Another good example, as we know, like the Japan Fukushima nuclear water will be poured into the Pacific Ocean. This is really another good example. So people need to pay more attention to the national disaster. Tokyo Electric Power, how big of this company? The net asset is probably about 110 billion US dollars. Unfortunately, they make the decision pour water into the ocean. Why? Because it's cheap. They just simply make the decision pour the water into the ocean. That's it. Doesn't make any sense. I think, generally speaking, that's from the common sense in China history. Peace brings money. So if you really want to make the money, that is always starting the peace and a good relationship. So right now, what China really want? Top level economic conference to outline 8 key missions for the 2021. So pay attention to here is China, they do want to make the good change and do want to make the reform. But in the reality, from the China side is a lot of the Chinese people and a lot of the decision maker, they may or may not have the very good experience to deal with the international world. They don't have the very experience. Think about it, China just get grow and for past probably 30 years, it's still very young and still just get the starting point.
Yeah, some of this is the old carrot and stick. You know, a lot of these countries, they're definitely looking for a trade partner. And most of these countries in the region, China is their largest trade partner. So of course they want good relationships. Unfortunately, there's another side of that, and it's who dictates the rules of trade. And if China wants to dictate the rules of trade, some of these smaller trade partners may feel at a disadvantaged position. I want to take 2 separate examples. The first is the Philippines, and the second is Indonesia. Duterte in the Philippines tried to abandon a 100-year-old policy to pivot to China. In fact, he hasn't even visited the US or any Western capital in 6 years. As Duterte begged for help, China signed toothless MOUs which convinced Duterte to proactively grant major concessions, including the decision not to assert the Philippines' arbitration victory against China in the South China Seas. After 6 years, China has made zero of the 24 billion promised investments and encroached on the Philippines' waters and secured energy resources. I want to contrast that with Indonesia, where Jokowi relied on a strategy of dynamic balancing among major powers, giving him room to maneuver. He visited both Beijing and Washington, and when China sailed into Indonesian waters in late 2019, Jokowi not only deployed fighter jets in the Navy, but personally visited the area to remind China that there would be no compromise over maritime and territorial issues. For foreign investment, Indonesia has courted a variety of potential partners, including the US and Japan, creating much needed competition. This strategy has led to some of the most favorable terms of any Belt and Road project. So what are the lessons here? 1, simply rolling over and begging gets you treated like a puppy. 2, hard negotiation gets you results. And 3, poking at political or social issues puts trade in jeopardy. Choose wisely.
Another, I think, good example, like the China and the VLAN. So they have a much more conflict on the territory argument. So that's, but under the two government that control, this still keep the peace of the South China Sea. So they can still make the good communication and work together to do it. Don't weaponize any sectors or any industry. So just make the trade and business is business, political is political. Let them separate.
Trade used to be trade, politics used to be politics. And in a lot of places, the China policy is exactly that. Trade is trade, politics is politics. But it does seem, specifically in the Australia case, that China has definitely linked trade with some of the social issues.
Yeah, that's another good example. I just talk about it from China perspective. And from other country perspective, they know even less than China. Australia has become the #1 companies to point a finger to the China. China really feel this is kind of the attack rather than any constructive suggestions. So they just do whatever they can to find them back. So that really means a small political group. They trigger the initiative or a political conflict, and other people suffer the consequence.
Yeah, I think more engagement is better than less engagement, and people have to be, very open and transparent about what their goals are, what their red lines are, what's on the table and what's not on the table. Otherwise, you're going to have this tit for tat, which just escalates, and that's not healthy.
And that's exactly right. I think that unfortunately, right now, we really need such kind of the constructive political conversation to solve the problem.
Yeah. Okay. Well, there's a ton to watch in South China Sea in trade. These are big trade partners. These are big deals. We're going to leave it here for today, but we'll probably revisit. So based on some feedback we've gotten, and the feedback was, okay, Gerard, peng.guo, just tell me what to do. As in, I want to allocate to China. How do I do that, and with what products? So peng.guo and I set up a hypothetical client. This is a family office, maybe 50 million in total assets, and they want to allocate 5% to China. Obviously, this is long-term, multi-generational money, and they don't want to spend too many resources managing this allocation. In our last episode, peng.guo said something important. The major index in China is not a great investment on a risk-adjusted basis. He said the Sharpe ratio is very poor, and we're going to put up a chart about that. So we have to get a little bit smarter and a little bit more targeted. So there are some constraints on this portfolio. There's a ton of China ETFs out there that this investor should absolutely avoid for the following reasons. 1, size, not enough AUM. You don't want to be more than 1% owner in any fund. 2, liquidity. If the trades don't trade a lot every day, you don't want to be caught if you have to liquidate. 3, thematic. Some funds are too narrowly defined. And 4, leverage. There's a lot of leveraged positive, negative ETFs that probably should be avoided. So with those constraints, I'll go first. You want broad exposure. And like we've always said, you should always have some fixed income. So the easiest way to do that is grab 70% CXSE and 30% CBON. I'll include performance data, picks, and all that other stuff. The 5-year annualized return for the portfolio is 17.09% with a standard deviation of 16.78. Contrast that with a normally aspired CSI 300, the major market index in China, the ASHR, which achieves significantly lower returns of 7.28% annually and a higher standard deviation of 22.31. So what's in CXSE? Tencent, Alibaba, Meituan, NetEase. Yes, these trade in Hong Kong. And yes, it's a lot of tech. But those names seem to be innovating and grabbing market share in tangential businesses, and they continue to grow. Of course, there's always the headline political risk, which just happened this weekend. Alibaba was fined a crisp 2.8 billion. And in terms of allocation, 40%, 44% is tech. But there's also a smattering of consumer exposure and financials. As with most things China, my thinking has evolved. At the end of the day, we shouldn't be dogmatic about where a stock is listed, particularly since there are multiple listings and constantly changing locations. What an allocator is tasked to do is get exposure, and I view CXSE as a smart way to get China exposure for foreign investors. Also have to comment on CBON, as it really is the only option for China fixed income unless you have a Luxembourg prime broker. So peng.guo, what are your thoughts in terms of this hypothetical client?
I think furtherly, the traditional model still works. So we do the asset allocation. We can still starting with the traditional model and use the index investment. Because China become a high efficient market, index investment will works. So the first thing is you need to select the index. For example, the consumer staples related topic, which get the stable growth and also can be kind of the defense. So it's a kind of the good topic. After you understand the sector's perspective, and then you can allocate the money with that and choose the related product. That is the first important things. And secondly, if you determine the weight, is you can either use a risk parity or equal weight or whatever popular weight related methodology to doing the work. And secondly, you have another way to think about it. It still came from the index. So like the Zhonghan indices, they create what's the contribution or the unique value. It really means separate the uptrend and the downtrend of the China index. Zhonghan created the family office index, but the key thing is try to keep the uptrend, so which is significantly reduce the volatility and improve the return. So just to stay in the uptrend is very important. If you don't know how to do it, just follow the Zhonghan indices.
So there you have it. There's a couple of different ways to go about it. We'll put more details in the description, or as we put them onto the screen, you'll be able to see how to execute on some of these strategies. That does it for us this week. Thanks for tuning in, and we'll see you next time.
Thank you.